For the first time in a while, I just added an entirely new company to my portfolio, and that company was Waste Management, stock ticker WM, currently trading at $156.36 per share. Now in this video, we have a lot I want to get to, such as why I added this company to my portfolio. We're going to be jumping into some of the investor's presentation and also seeing if we can calculate the intrinsic value of Waste Management. So let's go ahead and jump into it. Now we can see over the past year, the company's down around 7.57%, and year to date, down slightly around 0.43%. Now if we come down here, we can see the company has a somewhat low starting dividend yield sitting at just 1.8%. But let's go ahead and dig into some of those dividend metrics some more. If we scroll down, we can see the company's done a pretty good job of increasing their dividend payouts over the past decade. In 2013, they were paying out around 37 cents per share quarterly, and jump forward to now, it's now sitting at 70 cents per share every single quarter. If we look at those dividend growth rates, we can see pretty decent dividend growth. The 10-year dividend growth rate sitting at 6.6, 5-year 8.6, and the 3-year right at 8.6%. So overall, pretty solid dividend growth. Now we look at the dividend safety for this company and scroll down. The cash flow payout ratio is my favorite payout ratio to look at because dividends are paid out of free cash flow. And we can see the forward-looking cash flow payout ratio sitting right at 25% and the trailing 12-month cash flow payout ratio sitting right at 25%. To me, that is an excellent place for a company to be. Only paying out 25% of your free cash flow in dividends allows 75% of their free cash flow to go back to doing things like reinvesting back into the business, attempting mergers and acquisitions, or even buying back shares. Now, the end goal for my dividend portfolio is to one day be able to live off of dividends. So in order to be able to do that, I need to find great companies that will continue to increase the amount they pay in dividends every single year. So the thesis behind investing into Waste Management is actually quite simple. Due to the industry that they're in, it's extremely easy to see the pathway to generating more revenue every single year. And if we jump over to the income statement, we can see that's definitely been the case over the past decade. Look at their revenues in December of 2013 and jump forward to now and look what it's been for the trailing 12 months. That's phenomenal revenue growth over the past decade. With their gross profits margin staying pretty steady, we can see basically all of that found its way into the bottom line as the company's net income absolutely exploded over the past decade. Now I want to go ahead and jump into the investor's presentation, but I also want to point out one other thing that I found when researching this company. This company actually makes up a pretty large portion of the Bill and Melinda Gates Foundation Trust. We can see Waste Management makes up 14.5% of Bill Gates' entire portfolio. So to me, that's a pretty big sign of a lot of confidence in this company from the smart money. But let's go ahead and jump into the investor's presentation. Now there's a couple of things in this presentation that I want to point out. Now this presentation is about a year old. As you can see, it was formed in July of 2022, but there's still a lot of phenomenal information. The first thing that I want to point out is a little bit of their investment thesis. And again, it's relatively simple. This is a company that is very recession resilient. If we jump over to slide 24, we can see a chart dating from 2015 to 2021. We can see the green bar chart is showing adjusted operating EBITDA, but the black line is showing our free cash flow. Now you can see during 2020, there was a pretty big downturn in the market, but essentially Waste Management was unfazed by this downturn. They were able to continue generating more free cash flow. So when we jump back over to that fourth slide, again, this is a very recession resilient company. Now the next thing I want to talk about is their capital allocation. And we can see on their business and financial profile, they talk about having a strong and consistent free cash flow to fund balanced return to cash to shareholders and growth investors. So let's go ahead and jump into this a little bit more. If we go over to the 26th slide, we can see what their capital allocation looks like. And according to this report, it looks like they're targeting 40 to 50% payout of free cash flow. Now keep in mind, we did already look at that cash flow payout ratio. If we jump back over to dividend safety on Seeking Alpha and scroll down, for the trailing 12 months and forward looking, their cash flow payout ratio has been sitting at around 25%. So if they wanted to, they could bump that up to around the 40 to 50% they were talking about and pay out more in dividends and still be in a pretty comfortable area. Now the company has 19 years of consecutive dividend increases. Again, that's something I definitely want to see from a dividend investor standpoint. Now, one of the ways the company has been trying to aggressively grow is through mergers and acquisitions. If we come over here, we can see over the past 3 years, 32% of their free cash flow has been used to focus on mergers and acquisitions. That's a way to seek out aggressive growth. We can also see they have been focusing on share buybacks as well. So there's actually a lot of ways that this company has been seeking to provide shareholder returns, whether it's through dividends, mergers and acquisitions, or share buybacks. And if we scroll down to the next slide, you're going to see one of my favorite things to see as a long-term dividend growth investor. We have growing dividend payouts with a declining payout ratio. To me, that's a sign of an extremely healthy company. If you have a company that can increase the amount they pay out in dividends while also decreasing their payout ratio, that is an absolutely phenomenal sign. It means they're seeing explosive free cash flow growth, which in my opinion is one of the most important things that you can look for in a company. Now keep in mind, this chart only goes to 2022 when they were paying out $2.60 per share in dividends, but if we jump back over to Seeking Alpha, the company is actually now paying out $2.80 in dividends, so it's gone up even since then. Now with all of that being said, is Waste Management trading at $156.47 a good price to consider buying in at? Well, to answer that question, we do need to jump over to my stock valuation spreadsheet and run it through a few different valuation models. And like always, if you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in WM and hit enter, and you can see all this data will go ahead and load in. We already touched on this dividend data quite a bit, but if we come down here, we can see analysts currently have a target price of around $179.43. Institutional ownership pretty high at around 87.8%, and we did already talk about how Bill Gates has a pretty large majority of his capital allocated to waste management. Now if we jump back over to the spreadsheet, we can also see beta of 0.72. That means that you should see quite a bit less volatility with this stock than that of the market. Now, a problem a lot of people have with Waste Management is the price to earnings. Price to earnings is sitting at 28.11. A lot of people would claim that's way too high for a company like Waste Management. For example, if we plug in Apple and hit enter, you can see that their price to earnings is sitting pretty high at around 29.79. And if we plug in Microsoft, MSFT, and hit enter, you can see their price to earnings sitting at 34.18. So the concern is that Waste Management essentially has as high of a price to earnings as some of these tech stocks. But I would actually disagree that that's a problem. And the reason behind that is because it's very easy to see the path to future profitability for this company. Like we already talked about, they're very recession resilient and have been able to grow their revenues every single year, even during 2020. So in my opinion, you can somewhat justify a higher price to earnings for this company. Now, the first valuation we typically look at is Graham's valuation, but this is definitely not a fair valuation in the case of Waste Management. So we're going to keep moving forward and jump forward and look at the discounted cash flow analysis. Now, the idea behind a DCF model is we should be able to value a company based on how much free cash flow the company is going to produce in the future. So we need to project a growth rate to those future free cash flows. So what I've done is I plugged in the historical free cash flow for this company so we can see those year-over-year free cash flow growth rates. Moving forward, I'm projecting a free cash flow growth rate of 14% to the future free cash flows. I then found the present value of those future free cash flows and added them together, add the company's cash and cash equivalents, subtracted out the total debt to get their equity value. We then divide by shares outstanding, and I came to a discounted cash flow price per share right at $160. Now, the next valuation that we'll look at is the multiples valuation. This is a way to value a company based on how the market is valuing companies that are similar in structure. So we're taking these comparable companies, taking their stock price, dividing by earnings per share to get the price to earnings multiple. We take the average PE multiple, multiply it by Waste Management's earnings per share, and we come to an intrinsic value of $169.23. Now, the last valuation that we'll look at is the dividend discount model. The dividend discount model is a way to value a company based on how much they pay out in dividends and how much that dividend is increasing. So I plugged in the company's quarterly dividend payouts so we can see those year-over-year dividend payouts and the year-over-year dividend increases of 6.2, 5.5, 13.04, and 7.69. Moving forward, I'm projecting a dividend growth rate of 7%. Now, anytime you're projecting a high dividend growth rate, there's two things that you want to look for. The first is growing free cash flow, and like we saw, we are projecting a pretty high free cash flow growth rate, but we also want to see a low payout ratio. And we already touched on this quite a bit. The company, it looks like, has a very sustainable dividend payout ratio and cash flow payout ratio. So when we jump back over to our spreadsheet, that makes me think that this 7% dividend growth rate is sustainable. So with a discount rate of 8.5%, we come to a dividend discount model price per share of $199.73. So when we jump over to the output tab, you can see our DCF model came to an intrinsic value of 159.8, dividend discount model 199.73, and multiples valuation $169.23. That gives us an intrinsic value of $176.26, which if we jump back over to our stock screener, we can see that was actually pretty close to what we got for our analyst target price. So with a 10% margin of safety, you could see the acceptable buy price for this company sitting at around $158.64. With a 20% margin of safety, it's sitting at around $141.01. Now, like I already mentioned, this is a company I just recently added to my personal portfolio. It seems to currently be trading at a slight discount even when you apply a 10% margin of safety. Now, you do need to keep in mind what you're getting when you're investing into this company. The company does not have a high starting dividend yield. It's only sitting at 1.8%. But in my opinion, again, it's very easy to see the pathway to growing their dividend payouts year over year. This is a company that will be around for a very long time in the future, and I expect them to grow their revenues, their free cash flow, and their dividend payouts every single year for quite some time. And in my opinion, that gives me a lot of confidence in holding this company long term and helping me achieve my long term goal of one day living off of dividends. So there you go, there's a quick analysis on Waste Management Company. If you'd like to be able to download this spreadsheet and join a community of dividend investors, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.